Hey friends, welcome back. Welcome back. We're going to be talking about a much widely requested analysis of where the housing market is projected to go in regards to the US supply. And as we can see, the housing market has been in a bubble for the last 2 years. Prices have been extremely inflated. And we're going to talk about the economic conditions that are basically brewing right now to create the perfect crash or correction, as I like to say. I don't think we'll see a 2008 like crash. I think we'll see a very healthy correction. But yeah, let's get right in. We're going to talk about just some of the basic drivers that fuel housing demand and why they variate from cycle to cycle. Over the last couple of years, most countries on the planet saw double-digit percentage increases for housing prices. Us in the US, we have seen prices increase nearly 40% for median housing prices in 2021. And for the first time, I believe it was mid-2021 or the end of 2021, the median price for a single family household hit $500,000. So the price for a single family residential home, the median price was about $500,000 at the end of the year last year. And while the median income for the average household is only about 60K. So you can definitely see there's some discrepancies there. Inflation is rampant. Of course, the cost of living is rapidly exceeding the rate at which we've seen wage increases. So we're going to kind of dive right into the conditions that created the housing bubble that we're in and some of the economic trajectories that we're seeing in terms of a correction for the future. So some of the just basic housing demand drivers, you're going to be looking at the general condition of the economy, right? Right now, we are in a current state of hyperinflation. Interest rates are extremely high to combat inflation. Unemployment rate is growing, even though that you'll hear the Federal Reserve reference the labor market in a positive context, even though in reality, it shouldn't be. And the labor market is only thriving because most working class Americans now work 2 to 3 jobs in order to keep up with inflation and basic costs of living. So looking at the labor market to determine the health of the economy is very misleading right now, which I feel like is what the Federal Reserve keeps relying on. They keep using it as a crutch. Oh, but the labor market is booming. Unemployment is great. It's really not, because the labor market is only booming because inflation's so high, because people are working multiple jobs just to get by. We're going to be looking at consumer sentiment. People are spending less because of inflation, because we are in a technical recession. Of course, other basic housing demand drivers are going to be your actual supplied inventory, right? So for a long time in most of the world, the demand for housing has outpaced the actual supply. And I think we're about to enter a period where the reverse is true, where there's going to be an influx of supply that enters circulation that were purchased at peak prices during the last 2 years, and they're going to see 30-40% declines and negative equity, and we're going to see some inventory flooding the market. Renters demand does indirectly drive demand for housing, sometimes from an investment standpoint. So we have seen the prices of rent steadily increasing over the last decade. And there's a lot of obscure factors that do cause the rent prices to fluctuate so much. So illegal immigration is one of those things. Regardless of what your political beliefs are about illegal immigration, they all need somewhere to live. Everybody needs to live somewhere. So inadvertently, when there are influxes to the population, there creates a demand for rent, and that therefore creates a demand for investors to purchase more homes to rent to those people. So there are a lot of housing demand drivers that we're seeing. We're seeing a lot of investors that are scooping up inventory for rent, and we're kind of going to see a lot of pullback I'm hoping in these mortgage prices, not rates, of course, interest rates are going up. And there has been a really unique set of conditions that have put the housing market in the bubble that we're in. So I don't think we're going to see a 2008 like scenario, because the housing market crash of 2008 was heavily fueled by banks allocating credit lines to people that shouldn't have been able to have home loans in the first place. So basically not having any kind of filter for who banks were giving loans to and who they were extending lines of credit to, it caused an overwhelming inability to handle the debt. So due to that, we saw the housing market collapse, and we saw a recession soon thereafter. And then what did we see directly after that? We saw institutions purchasing all of the foreclosed residential homes. We saw a lot of institutions purchasing all of this real estate that went onto the market, all of the influx and supply that happened in 2008. We saw the investors and the institutions, ready to strike on that opportunity. They were ready to move when the bottom fell out of the market. And that's kind of what I'm hoping is going to happen very soon. My husband and I, we are in the market for a house. So we have been tracking this very, very closely and doing a great deal of research. And my husband is a real estate developer. So this is definitely an industry and a sector that he gets a very privy kind of very privy to the kinds of movements within the sector that are going to directly impact housing prices. So we've talked about some of the reasons that we've been put into a housing bubble, and COVID had a really unique place in causing this bubble and causing the overinflated prices of real estate. So material input costs we saw during 2020, we saw unprecedented levels because of supply chain problems. So think of everything that's required to build a house, right? Wood, PVC pipe, brick and mortar, whatever the raw material input is. During COVID, we saw a lot of global disconnects, and we saw a lot of global shortages because of the shutdowns, the whole world handling the pandemic in a different way, everybody taking their own approach, therefore causing supply chain lags. So we saw prices fucking soaring because of the basic raw material input costs were soaring. So it was more expensive to actually build homes during COVID because everything was on back order. Shipments were getting, lost at sea, shipments were getting delayed, all of these disconnects and all of these issues within the supply chain that generally didn't see many interruptions. That was definitely a really unique driver on the soaring costs of houses, and demand was significantly outpacing the supply. So while there were all of these back orders, while the cost of lumber was very high, the demand for these houses was going up. So the demand was outpacing the supply, which, basic economic 101, scarcity creates demand. When there is not enough of something, that inadvertently causes the price to go up. So we saw the median housing prices surging during COVID because of the lack of supply, because of the supply chain shortages, and because the actual input costs to build homes were going up so much that we saw that reflected in the price tags from home builders. So being that the acceleration in housing prices immediately following COVID, again, we've already talked about this, it's very different from what we saw back in 2008 because COVID had a very unique set of economic conditions that we hadn't necessarily seen before, including a stimulus economy. So we can see what the housing percentage changes looked like in 2008, and we can see what they looked like in January of 2020, which was kind of the start of the global pandemic lockdowns and federal regulations and responses to the pandemic. So we can see how much the housing prices accelerated once COVID started. But what's so different about the 2008, where we still had very cheap debt, don't get me wrong there, we had low interest rates, they were near zero. And we also had extensions of credit to people that, maybe shouldn't have had such large lines of credit that caused the housing crash. Where it gets a little different in regards to COVID, we were in a stimulus economy. There were a lot of landlord moratoriums. And what does that mean? That just means that basically there was a lot of federal regulations that forced landlords to not kick out their tenants, even if they weren't paying rent. So we saw a lot of moratoriums. We saw cheap debt. Interest rates were very close to zero for a long time. And of course, when interest rates are lower, housing prices are generally higher. They usually balance themselves out, because what are we seeing right now? Interest rates are approaching almost 6%, and we're seeing the price tags fall. We're seeing, $10,000 deduction here. We're seeing $25,000 slash here. So there was a very different set of economic conditions that were fueling the crash in 2008 than there is now. And than there was during COVID, with the moratoriums, with the stimulus economy, with the very low interest rates. So we talked a little bit about how much we saw the median single family house increase. We saw the price tags increase to a median price of nearly $500,000 during 2021, when the median household income is only about $60,000 in the US. And that's for a two-person household, bringing in two incomes, meaning. So let's take like a fast forward into what the economic conditions look like right now, like real time, and not like a future trajectory, not like a past analysis, but just right now. So what we're seeing that is going to have a huge impact on where the pricing of houses go. Of course, inflation. inflation is going to be, of course, one of the main drivers, because how inflation is handled is basically contractionary monetary policy. The reason the Federal Reserve is raising the rates is to combat inflation. We got to keep a close eye on unemployment. We've seen a lot of mass corporate layoffs and hiring freezes. My own company, I work for a nearly $20 billion company, and we've had 2 mass layoffs in the last couple of months. Microsoft has had layoffs. Google has had hiring freezes. Apple has had hiring freezes. IBM has had layoffs. Airbnb, Netflix, DoorDash, Uber, all of the pillars, all of the giant behemoth companies, they've all had layoffs and hiring freezes. And this is important because, when the consumer has less buying power, they have less buying power, and they're not going to be spending, on the things that they would typically spend on. It's going to be more allocated towards necessity, and it's going to be their funds are going to be more allocated to savings. So we got to keep an eye on unemployment. We got to keep an eye on consumer sentiment, inflation, increasing interest rates. Your mortgage rates are directly correlated with the 10-year treasury yields, guys. So skipping over to the next slide, the 10-year treasury yields, we can see essentially how they've trickled down from the 80s and where they're kind of trading at starting at the 2020 benchmark. Treasury yields are essentially the percentage that the government has to pay on its debt. And it's also the same percentage that investors in government bonds would receive for investing in those bonds. So you can see in 2020, the treasury yield rate was just over 4%, meaning that this is what the government was paying on their debt in interest rates. So you can think of it like this: when the government's debt gets more expensive, so does ours. Your credit card interest rates will go up, your mortgage rates are going to go up. And that is all because the 10-year treasury yields, which tracks the government debt and tracks the interest rates that they're paying on that debt, When that increases, all of your debt is going to increase as well. Your car note, everything, student loans, any kind of debt that accumulates interest, you need to pay close attention to the 10-year treasury yields because it is directly correlated with what the treasury yields are trading at. So again, that's something that we want to keep a close eye on. We want to also keep a close eye on the supply chain issues that are being caused by Russia and Ukraine. So we saw a lot of supply chain issues because of the pandemic, because of the flaws and the rampant demand that was outpacing what, you know, producers were able to supply. But fast forwarding to where we're at right now, it's different because just it's different. The conditions are not the same, even though the responses to the conditions have been very similar by the government, if that makes sense. So we also need to keep a close look at what's going on with the US and Taiwan. There's a lot of tension. As you know, Taiwan is the largest exporter of semiconductors, which are in every electronic device that you own. There are microchips in everything. And being that they export, I believe, 92% of the world's computer chips, us having a strain with this region is basically causing economic trade routes to be redrawn. And I've talked a little bit about this, like on my Instagram, I've ranted a little bit about this. What's happening in silence is the US is silently being boxed out of economic trade with China. Like they're silently making moves with giant countries that might not have the GDP that America does, but they have much larger populations and therefore they have more consumers. So I'm not going to get too much into the US-Taiwan conflict because that's not the focus of the video, but it is definitely something to be very aware of in terms of our debt. We are heavily in debt to China. So we got to keep a close eye on this. We're also seeing currently how the buyer's demand for housing, contrary to what we saw during COVID, where the demand was outpacing the supply, we're going to see the reverse of that very soon. And the reason for this is interest rates. Interest rates are very high. We're going to see investors that have purchased homes for Airbnb, for rental properties. We're going to see a lot of investors deleveraging. So what does this mean? There's going to be an influx of housing inventory that hits the market that is basically going to outpace demand. So we're going to see the exact opposite happen of what we saw happen during COVID. And this demand is going down. So when supply is going up and demand is going down, that inadvertently is going to see a diminishing price tag. You're going to see a diminishing price tag on each home. And it's not going to happen at the same time, you know, everywhere at once. It's not going to happen around the globe at the same time. You know, Europe has been operating on negative interest rates for like the past 12 years, and they're just starting to increase their interest rates into the positive territory. So we have also seen housing prices in Europe going berserk as well. And this is all just, it's very closely correlated with just the economic conditions. You know, we're in a recession here in the US. And again, we've talked about the corporate layoffs that contributes to unemployment. We've talked about inflation that directly impacts what interest rates are going to look like. And we've talked about the 10-year treasury yields and how that is directly correlated with your mortgage rates. So next, we're going to talk about, you know, just what's currently driving the demand for housing. You know, we talked a little bit about it already, interest rates. The supply of housing is going to outpace the demand, which essentially is causing the prices to go down. This is basic economics 101. When you have scarcity, when your demand is more than your supply, the prices go up. When you have an excess inventory, when you have too much supply, your demand is going to fall, right? So another indicator, of course, is the price of lumber. So during COVID, we saw, because of the supply chain issues that we keep coming back to, we saw material input costs going up. So the cost of housing, the cost of building housing was going up a lot. And we're seeing lumber as a leading indicator of the housing market trajectory. We're seeing it fall. So we're seeing the prices of lumber go down, which is a great sign in terms of, a buying opportunity. So the actual material input costs have gone down to build homes. So that's all obviously a great sign, and it's a really good spot to be in. So what does all this mean? Where are we? What's going to happen in the housing market? Is it a good time to buy? Well, just some key takeaways. The average national mortgage rate is at 5.5%. And you have to think about compound interest, right? So if you're in Florida, I'm in Florida, and you're seeing, 1,500 square foot houses for 300,000, and you get in at an interest rate of 5.5%. Whereas just a couple of years ago, interest rates were at like 1.5% for mortgage rates. You're going to see a level of unaffordability, and you're going to see people at risk for negative equity. And we're already seeing this negative equity, and this inventory is soon going to flood the markets in the next 2 quarters, right? But the demand for these houses, the demand for the inventory that's about to hit the markets, is likely to keep going down because the Federal Reserve has promised to continue their contractionary monetary policy through interest rate hikes. So the Federal Reserve, Jerome Powell, has already promised another rate hike before the end of September because inflation has not gone down to levels that are comfortable. So material input costs have declined. That's always a good sign. We have kind of talked about the indirect impact that illegal immigrants have on the cost of rent. And the cost of rent is indirectly tied with the demand for housing. Again, because we talked about the investors that only purchase for the sole purpose of that home being a rental property. So everyone needs somewhere to live, whether you can afford to buy a house or not, or whether you need to rent. It is still going to create a demand for, the people that can't afford to buy houses or can afford to buy multiple houses. And, adding that other revenue stream, they're going to continue scooping up real estate to provide the rent. They're filling a need. So the crash won't happen everywhere at once. But basically what we're seeing is a lot of different conditions that are going to make housing prices, I think, like significantly cheaper in the next few months. But again, you're going to see the nominal price tag fall, but your interest rates are still going to be above 5% for a good amount of time. So when you're thinking about compound interest, 300,000, 5% this year, compounded 5% next year, compounded 5% the next year, across a span of 30 years, that, you're looking at least 150,000 added onto your price tag in just interest payments. So is it a good time to buy? It's hard to say. It's always hard to say. There's never a good time in the market. Like, to be completely honest, there are better times. There's a spectrum, right? So we've seen material input costs go down, and we've seen mortgage rates go up. We've seen we've seen an influx of supply from negative equity coming into the market. But again, this is likely going to continue into the next 2 quarters. And that inverse relationship between the supply and demand are really going to be the most telling factors on like, when is this a good time to buy? Like, I'm going to be tracking this very closely because of course, you know, I'm looking for a house. So we're looking for a home, and, you know, we're just keeping a really close eye on the treasury yields and, you know, how expensive debt is right now. We've gotten to this point of inflation because of how cheap debt was. Interest rates have been close to zero for a long time. So it's, you know, I know you came to this channel looking for like, is now a good time to buy? I just wanted to provide you with the facts, and I definitely will have another video probably in the coming future here, but there's just a lot of things to consider, right? So there are a lot of moving parts that affect the housing market and the prices of housing. And I don't think right now at this moment is a great time to buy, because I definitely think we're going to see, some heavy declines in price tags. I think once that Airbnb inventory hits, I think we're going to be in a really good spot for housing affordability, at least in Florida. That's where I'm based out of. But if you guys found anything helpful or insightful, you can click subscribe, leave a comment, like the video. If you didn't like it, tell me what you'd like to hear more of, what you'd like to hear less of, what you know, give me some feedback. That's it for today, friends. I'll try to have a video about the student loan act. I'll try to have that for you guys pretty soon, but until next time, friends.